Discover how easy it is to start investing today and unlock the potential for building steady passive income streams. Hey everyone, welcome back to the Money Guru channel. Have you ever thought about generating easy passive income, or how you can make money in your sleep, or building generational wealth? It sounds like a dream, right? Well, today we're going to teach you basics to begin making that dream a reality. I'm going to walk you through everything you need to know about the basics of investing, how to get started easily, the risks involved, how to grow your portfolio, where you can start investing, and most importantly, how you can live off dividends. By the end of this video, you'll know how to build a solid dividend portfolio, how to choose between high and low dividend yields, why diversification matters, and how you can use strategies like drip and cost averaging to maximize your returns. If you're serious about financial independence, then stick with me. Let's start with the basics, why you should consider dividend investing. As a dividend investor, you will earn returns from well-established company profits, giving you prime opportunity to earn regular income and increase that over time by reinvesting those dividends for growth. What exactly is dividend investing? Dividend investing is simply the strategy of buying stocks in companies that pay dividends to their shareholders. Dividends are regular cash payments made by companies to reward their shareholders, and they typically come every quarter. When you own these stocks, you're not just waiting for the stock price to go up, you're getting paid to hold on to those stocks. But here's the thing. While dividend investing can be an incredible way to generate passive income, there are risks to be aware of. For instance, if a company faces a downturn or financial trouble, it may decide to cut or eliminate its dividend, meaning you lose that income stream. This is why it's important to choose companies with a track record of stability and strong financials. That's why understanding the terms behind dividend investing is crucial. Terms like dividend yield, dividend payout ratio, and dividend growth. Let's break them down. What is the dividend yield? The dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. The reciprocal of the dividend yield is the total dividends paid divided by net income, which is the dividend payout ratio. We define dividend yield as the amount of money a company pays shareholders for owning a share of its stock divided by its current stock price. Let's talk about the difference between high and low dividend yields. High yields look appealing at first, but they can be risky. A high dividend yield, say 7% or 8%, might seem like a great deal, but sometimes that's a red flag. It could mean that the company is struggling and it's paying out more than it can afford. If a stock price drops, that yield can become less reliable. So you might get paid, but the stock could also lose value because of a very high risk of volatility. Higher dividend yields don't always indicate attractive investment opportunities because the dividend yield of a stock may be elevated as a result of a declining stock price. Companies in the utility and consumer staple industries often have relatively higher dividend yields. You can take a look at Edison International, Portland General Electric Company, and Compañía Energética de Minas Gerais as examples. Additionally, real estate investment trusts, master limited partnerships, and business development companies pay higher than average dividends. However, the dividends from these companies are taxed at a higher rate. Check out Main Street Capital, Realty Income Corp., AGNC Investment Corp., and Magellan Midstream Partners. Low yields, on the other hand, like 2% to 3%, are typically from companies that are more established and have a long history of paying dividends. These companies are often referred to as blue-chip stocks. They may not have the highest yield, but they offer reliability, and their dividend payments usually grow over time. Some popular blue-chip stocks include Johnson & Johnson, Coca-Cola, and Procter & Gamble. These companies have been paying and increasing their dividends for decades, making them a safer bet if you're looking for stability in your dividend income. To sum up, high yields can be tempting, but always consider whether the company can sustain that payout. Look for companies with a payout ratio around 40% to 60%. This shows that the company is making enough profit to cover its dividend while still investing in growth. Now let's talk about diversification, which is key in any investment strategy. Diversification means spreading your investments across different sectors or industries. You don't want to put all your money into one stock or one sector, because if that one stock or sector drops, your entire portfolio will be impacted. For example, you could invest in utilities for stable dividends, tech stocks for growth, and consumer goods for steady income. Each of these sectors behaves differently, which reduces your overall risk. Here's an example. Let's say you put $10,000 into Coca-Cola, but the beverage industry faces some tough times. Now imagine if you had diversified into technology stocks like Apple and Microsoft, or utilities like Duke Energy. That gives you a more balanced approach. If one stock takes a hit, the others might still be performing well, reducing your losses. Let's dive into one of the most powerful strategies for growing your dividend income, the Dividend Reinvestment Plan, or DRIP. DRIP allows you to automatically reinvest your dividends to purchase more shares of the stock you already own. It's like getting paid to buy more of your stock, and it's a key strategy for growing your wealth over time. The best part? You don't have to add any more money, you're just reinvesting your earnings. Let's say you own 100 shares of a company, and each share pays a $1 quarterly dividend. Instead of cashing out that $100, DRIP automatically buys you more shares. Over time, this means your dividends will start compounding and growing exponentially, which is one of the best ways to build wealth without having to actively invest more money. DRIP is a long-term strategy, so be patient. The more shares you have, the more dividends you'll receive. This cycle of reinvestment will help you build your dividend income faster than if you were simply pocketing the cash. Another strategy to help you grow your portfolio is dollar-cost averaging. This involves investing a fixed amount of money into a stock or fund on a regular basis, regardless of the price. Why is this important? Because it takes the guesswork out of trying to time the market. By consistently investing, you're buying more shares when prices are low and fewer shares when prices are high, which averages out your purchase price over time. Let's say you invest $500 every month into a stock. Some months the stock price might be high, and other months it might be lower. By sticking to this consistent investment plan, you're less likely to get burned by trying to buy at the perfect time and instead allow the market to smooth out over the long term. So, how do you actually get started with dividend investing? You need a platform to buy and sell your stocks, right? Well, there are several platforms out there, but if you're just starting out, Robinhood is one of the most popular for entry-level investing. Robinhood is great because it's simple to use and they don't charge commissions for trades, which is perfect for beginner investors. You can even buy fractional shares, which means you can start investing with as little as $5. So, if you want to get into dividend investing but don't have a lot of money to start with, this is a great option. But there are other platforms you can consider too. Fidelity, Charles Schwab, and E-Trade offer more research tools and resources for investors who are ready to take things to the next level. These platforms also provide more robust trading features, which may be helpful as you grow your investing knowledge. Robinhood is awesome for beginners, but if you're looking for more educational content and you plan on diversifying more into different types of investments, consider checking out Fidelity or Schwab as your next step. Now that you know the ins and outs of investing, it's time to get started. In future videos, we will discuss the basics of taxes when you invest. Remember, the key to success is consistency, diversification, and patience. Start small, reinvest your dividends, and before you know it, you'll be building a solid income stream that grows over time. If you enjoyed this video, don't forget to hit that like button and subscribe for more tips on personal finance and investing. Let me know in the comments. What dividend stocks are you interested in, or what platforms are you using to start your investment journey? Thanks for watching, and I'll see you in the next video.